Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, the show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. Welcome back to the Coffee Break Sessions. I am here with Paul Galloway to talk about capital management. Welcome to the show, Paul.
Yeah, thanks, John. Good to be here.
You want to jump right in and tell us what is capital management?
Yeah, capital management, in broadest sense, is how an organization manages what's on their balance sheet. So you think about balance sheet management, capital management is tied directly to that. You have sources of cash, uses of cash. When you think of those two things in tandem, organization is trying to do a couple things. One, ensure that they have the right sources in place on their balance sheet for the uses that are today or in the future. And so uses of capital could come in the form of organic growth, meaning you're developing new products and services, and you need capital to fund that. It could be that part of what you're doing in addition to that organic growth is you're going out and you're buying it. You're buying up companies, organizations that you go into a joint venture with, maybe an LP or something else where you're collaborating together versus a full M&A transaction where you bring it all in-house, but it takes capital to acquire the particular product or service that you need to deliver to all your customers. And so what happens from a corporate finance standpoint is they project out what they think is going to happen over the next 1 to 2, up to 5 years. Typically, you go up to maybe 5 years. You have an FP&A team that will help do all these projections. It'll give you an idea of where gaps and needs might be. Maybe you have obligations to shareholders. You have obligations to anybody that is a lender. You have obligations to your employees, your customers. So it puts demands on cash while having the right amount of capital in place in addition to the cash flow that you bring into the organization is important. So it's how you fund or capitalize the business as a going concern. Let's take, for instance, publicly traded companies. That could be stock that's issued. It could be senior debt. It could be term loans. It could be your credit facility or revolver. It could be the credit that banks put in place for you to utilize. It could be a variety of things where you're able to get sources of cash or capital for the future, today and into the future. So it's not just cash flow that comes in, it's also that capital that helps build out the future of the organization as a going concern.
Okay. Can you tell me a little bit about the structure and what matters, what's important to keep in mind in capital structure?
I think a great way to put that is think about if I'm a publicly traded company and I can issue stock to capitalize my company, does it make sense to 100% fund it with equity? I go out and I sell nothing but shares. I don't take on any debt. I fund the company with equity. Well, no, it really doesn't make sense because when you think about the hierarchy of costs associated with capital, funding with equity is really costly. As a matter of fact, it's the highest cost. I don't want to fund all my operations at 14, 15%. I want to lessen the overall amount of capital costs. And in order to do that, I'll go to the debt side. And so you got equity on one side, you got debt on the other. Now, likewise, I don't want to fund everything with debt because it's just not really possible. Lenders are only going to let you borrow so much. And if you're publicly traded and you're rated by a rating agency, the rating agency is only going to limit so much that you can borrow to be within a certain rating. So you can't do all debt either. So it's a combination of debt and equity. When we put these two together, we look at it and we call it the weighted average cost of capital, or WACC. You may have heard that before. It's a term that's commonly used in corporate finance. It's something through capital management that you monitor. You want to try to optimize that cost of capital. And so the way you structure debt and equity matters in order to get to that optimized level.
You mentioned optimization. What do you mean by that?
Yeah, I kind of just hit on this idea or this concept, John, of optimizing your capital structure. I didn't really talk about what that means because I could set the amount of equity and the amount of debt funding that I have such that I have the lowest weighted average cost of capital today. The thing is that moves around. Why does that move around? It moves around for a variety of reasons. One, equity capitalization, it changes over time. So it's moving on the balance sheet. Equity's going up and down for everything that's going on in the market, everything's going on with the business. You're generating revenues, generating capital, capital's being used, capital's not being used, you're retiring stock, you're doing all kinds of different things. That has an impact on the equity side of things. Likewise, on the debt side of things, maybe you're adding more debt onto the balance sheet. Maybe it's through leases. Maybe you're issuing debt. Maybe you're doing the opposite. You're extinguishing debt. So you're paying debt off. So you're lowering the amount of debt that you have. And so that weighted average cost of capital is constantly fluctuating. So what I mean by optimization is that you try to get the right mix and balance so that you aren't, when you think about rating agencies, you're not tripping that rating that you want to maintain. So you're keeping the right amount of debt to equity on your balance sheet so you don't trip the rating. But you may be pushing the limits, meaning you're getting as close as you can without tripping over. And maybe, your threshold is within 5% or 10%. I don't know what that might be. It's different for every company. But you're going up near that, but not all the way to it, to get the optimized weighted average cost of capital. And so that's a moving number, and that changes over time. But the idea is that you focus on the right balance to maintain ratings and at the lowest level of cost possible for the entire organization. That will generate a better return to your investors if you're optimizing the total cost of capital.
And you mentioned credit ratings. Do credit ratings matter, and why?
Yeah, that's a great question, John. I kind of just touched on that lightly, but for a lot of organizations, credit ratings do matter. And why is that? If you're going to make an investment in bonds, bonds are typically rated by S&P, Moody's, Fitch, AM Best. You've got these rating agencies out there that are looking at the credit worthiness of these particular bonds. Well, bonds are debt that are issued by organizations, companies. They issue debt to fund their operations. This capital management I was talking about. Well, costs associated with that funding, if your ratings go down, the costs will go up. Okay? You don't want your ratings going down if your goal is to optimize and maintain the lowest cost of capital possible. So to organizations, monitoring and making sure that that rating is held at the level that they want it at is important to them. Now, is there a lot of variance between an organization that's, highly rated and maybe one or two notches below? It may not be significant, but there is increased costs associated with it. What you don't want to have happen is, hey, you're an investment grade company, something that is considered, triple B or greater by, S&P and Moody's, and go below that. The old term you may have heard of is junk bonds or non-investment grade. Once you start getting into the non-investment grade arena, the costs associated with capitalization start increasing quite a bit. So it's about that overall weighted average cost of capital and ensuring that you're able to do business, which part of doing business is capitalization of the future going concern itself through raising capital. You want to maintain those lower costs. You want to maintain the rating level that gets you to where you want to be.
What kind of things are going to drop your rating?
What could happen is if you decide to go beyond the debt to equity threshold that a rating agency has set for you, meaning you're taking on debt that increases the amount of total debt you have as an organization, that could lower your rating. If you trip covenants that you have for the particular issuances you did, so you issued senior debt or some other kind of term loan and you tripped it, there are various covenants within these documents that companies have to adhere to. And it can be, can be tied to debt that you take on. It can be tied to how the business performs. Things that the business is not supposed to do, but they did it. And that's a covenant in place. Hey, you shouldn't do this. You do this, it means this. Or the organization doesn't do something that a covenant says it's supposed to do. Those kinds of things can cause a rating agency to consider a downgrade for an organization, especially if the company is starting to fail in terms of the revenue expectations that they're expected to meet, and they aren't meeting their obligations in terms of making payments, the debt that they have in place. If you miss principal and interest payment, that's a big deal. Rating agencies notice that right away, and they will take action.
Anything else you want to leave with listeners?
No, I think it's, capital management is just really important to organizations, how you manage your capital. Working with your FP&A team as a treasurer is really important. Staying tied to what your C-suite executives are doing, especially your CEO, the product development, the future needs of the organization, whether they're going to grow that organically or buy it. These are things that a treasurer needs to be tied into so they can help effectively manage the capital that's on the balance sheet and help maintain that optimized level of weighted average cost of capital. This is important stuff. Treasurers should be all over this on a regular basis.
Great. Well, thanks. To our listeners, make sure you tune back in every first and third Thursday of the month for another coffee break session.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.